Welcome back. In this session, I was planning to continue with my data updates that I've been doing this year, and I've been slowed down by distractions. And this week, we have another distraction, and a pretty gigantic one. As you well know, if you've been tracking markets, no matter where you are in the world, the coronavirus is in markets. The market is caught a viral infection, so to speak. And as we watch these markets melt down, I get a sense of deja vu because every year for the last decade, we've been tested with a market crisis each year. Sometimes these crises are caused by political developments. Remember Brexit. It could be because governments get into trade wars. It could be war and terrorism, the US-Iran standoff. And sometimes by economics, the Greek default. This one is a little unusual because it's caused by a virus, but it's still the same effects. How will it play out? And every time you get one of these big market meltdowns, you have a debate. And this debate is internal. Part of you wants to flee, saying, let me get out of the market. This is the big one. The correction is coming. The other is, hey, this too shall pass, because for much of the last decade, the markets have rolled over crisis and come back stronger than ever. And after the last couple of days, and especially over the last week, as we've seen markets melt down, this question has come up again. And I've discovered that whenever these big moments come, that the last thing I should be doing is listening to experts tell me what to do. So here's what I'm going to do. I'm going to go through a framework I go through pretty much any time I run into a market crisis. I start by looking at the core reason. In this case, that core reason is the coronavirus. So that's a pretty straightforward place to start. The only problem is I'm not a doctor. I don't know enough about infectious disease. So as a novice, here's what I know about the coronavirus. The virus originated in China. We're not quite sure how it made the jump into the human population. There are some conspiracy theories out there. I won't go there. The Chinese government initially tried to keep a lid on it, and who can blame them? They wanted to prevent the panic, and in a sense, it's made it more difficult for them to be credible in the weeks after. It's taken a toll, especially in the Wuhan province in China, where the virus had originated. Thousands of people have been infected and hundreds of people have died. In fact, the rough estimate is, and this is a running count, which will obviously get updated as we go through time, there have been more than 80,000 cases of the virus with more than 2,700 fatalities. It is now crossing borders. Initially, the view was it's going to get stayed pendant in China, but I don't know how you could have that because people travel. Initially, the countries were affected were in the immediate vicinity, Singapore and now South Korea in the last week. But it also jumped borders, but usually because people travel. There were occasional cases that you read about in the US or Europe. But last weekend, we got a very troubling news story out of Italy where you got a cluster of cases, which suggests that either the disease is a little more communicable or much more communicable than we thought it was, and perhaps it has the capacity to become a pandemic. That's a scary word. It's not been called a pandemic yet, but it's got the potential to be a pandemic, and right now there is no cure, no vaccine. And the mortality rate varies widely depending on who gets it and where you are in the world. Older people with some degree of problems already, and very young children seem to be more at risk. And the mortality rate seems to be higher in China than it is in parts of the developed world where you see it in the US and Western Europe. So that's the background of the virus. As I said, I'm not a disease specialist. There are people who've forgotten more about this in a night than I know all about it. But I want to turn my attention to the equity markets. Obviously, we've had a terrible week for stocks. They're down about 7 to 8% just in the last week. But one of the things I think we lose whenever we're in a crisis is perspective. And sometimes it's good to step back and ask, well, how far have we fallen? So what I've done in this graph is actually looked at the S&P 500 going back a week, and you can see the big drop, but then going back a month. And from the start of the month, the drop has been relatively small. And you go all the way back to a year, 2 years, 5 years. If you're complaining about how much stocks have gone down, I mean, you really don't have a good basis. We've had a good run, and that's both good news and bad news. It's good news in the sense you still have a big chunk of your profits in your portfolio if you bought long enough ago. The bad news is we've had a really big run in stocks. So if there is in fact going to be a correction, it could be a pretty brutal one. So this perspective gives you both good and bad news. Now, whenever again you see a market meltdown, my reaction is to go back to a framework I'm comfortable with. I'm not going to push this one on you because it's a framework that I find useful, and it's a framework that goes back to value. As somebody who believes in value, ultimately I think everything has to show up in the numbers. So this is my picture of the value of an index, and it's a picture actually used to get an implied equity risk premium, but here I'm going to use it in a different format. So if you look at what drives the value of the index from an intrinsic value perspective, there are expected cash flows in the numerator, and there's a risk-adjusted discount rate in the denominator. Let's break it down. My expected cash flows in the index are a function of my base year earnings and how quickly those earnings will grow. And how much I get as cash flows will depend on what percentage of those earnings companies return to me in the form of dividends and buybacks. When you look at the required return across all stocks, there's a risk-free rate. That's my starting point. And to that, there's an equity risk premium. And there are 4 numbers that potentially could be affected by this viral attack, by the coronavirus. Let's start with earnings. There is clearly going to be an impact on earnings, and both in the near term and the short and the long term. So the question we've got to assess is how much will this virus affect earnings in the near term and the short term? That's the first starting point. The second is how much companies' return of that earnings and cash flows depends on how confident they feel about the future. And they're returning a pretty high percentage of earnings right now. We'll see the number actually in a few pages. And if the virus shakes their faith, it shakes their confidence, they might reduce less. That could affect the cash flow. So earnings growth could drop off and perhaps become negative, and cash flows could become lower. If you drop below, the virus, by creating a market crisis, is creating a flight to safety. You're seeing risk-free rates drop across the world. The T-bond rate is down significantly from where it was a week ago. And that's without central banks even acting. I'm not sure what central banks can do when rates are this low, but the risk-free rate is already starting to move, and it's a function of the crisis. Equity risk premiums reflect how concerned you're about the future, how worried, and the fear factor shows up as a higher risk premium. So earnings growth is going to be affected, cash flows could be affected, the risk-free rate will change, and the equity risk premium could be different. So let's look at how much of a change we can expect. And it's very early in the crisis. There's so much we don't know. So this is just a very preliminary guess that I'm making at these numbers, and I'm going to come back and revisit them. When you look at the earnings effect, there are 2 layers in which you're going to see the effect. There are some companies, hotels, airlines, travel-related companies, where you're seeing the impact directly in the bottom line in revenues. In fact, yesterday, United Airlines announced that it was withdrawing guidance about revenues in the future. And who can blame them? They really don't know what's going to happen. So there are companies directly in the middle of the storm where the earnings are going to be affected because revenues are affected. But the bigger issue with the coronavirus is because it's affecting China, and so much of our manufacturing comes out of China, there's a supply chain effect that's going to be much wider. Walmart might not get much of its revenues from China, but it has a big China exposure through the supply chain. So there, the earnings effect is going to show up as higher costs if the supply chain starts to break down. So clearly there's going to be an earnings effect. The question is how much. And my suggestion is you look at it in 2 phases. One is the effect it's going to have in 2020 earnings, where it's going to be pretty substantial. And then a follow-up question of how much will it affect earnings in the long term. And here's why I would separate the 2. Often when you have crises like these caused by a virus, same thing happened with 9/11 and terrorism, there was a pullback in buying by consumers, but it wasn't a permanent pullback. Once the crisis faded and people started to feel more comfortable, they went back to spending. In fact, much of the earnings that were lost during the crisis came back. There's a surge back. So when you look at this crisis, you got to ask 2 questions. How much of an effect will it have in 2020 earnings, both directly and indirectly through supply chains? And how much of this drop is going to get recouped in the following 4 years? So let's look at 3 possible scenarios. The best way to read this graph is the blue line is the pre-virus estimate of earnings I had for the S&P 500. And I've looked at 3 scenarios where the crisis kicks in. And in all 3 scenarios, 2020 is a bad year. Earnings drop by about 5%. That might not sound like much, but a 5% drop in S&P 500 earnings is a pretty bad year. But then I look at what happens in the following years, and I look at three possible scenarios. My best case scenario is you completely recoup whatever you lost in 2020 by higher earnings in the following year. So if you see in that scenario, the earnings climb back to pretty much what they'd have been without the virus. The second scenario, the worst case scenario, is you recoup none of those earnings. And what happens then is the earnings drop and they stay below your expectations all the way through. And there's a middle scenario where you get some of the earnings back. My guess is that if you're United and you lose vacation revenues this year, that people are not going to take 3 vacations next year, that some of those revenues are gone forever. A supply chain related cost thing will be temporary, and there you're much more likely to see a bounce back. So that's your earnings growth, the first part of your story. Now let's talk about cash returns. In 2019, the companies in the S&P 500 returned about 92.5% of their earnings in dividends and buybacks. That's a really high number. Part of it is driven by the fact that companies have a lot of cash to return and cash coming out of the trapped cash that they had before the tax reform kicked in. But part of it also reflects the confidence companies were feeling about their capacity to generate earnings and cash flows in the future. To the extent that this virus is going to shake that confidence, companies might not be able to return or be willing to return as much cash. And if you reverted back to the average cash return over the last decade, that's about 85.24%. So let's assume that that's the effect on the cash flow. So earnings growth is going to be affected, perhaps turning negative in the near term and perhaps remaining lower for the next 4 years. And less cash is going to get returned. Let's look at discount rates. There are two pieces of the discount rate. In a sense, one piece might offset the other. Let me explain. The equity risk premium by itself was about 5.2% at the start of February 2019 before the crisis fears kicked in. That number might be as high as 5.4, 5.45, maybe even 5.5% after the last week. And that's at the high end of the spectrum of equity risk premiums. And that's perhaps good news because we were at 3 or 3.5 or 4%, you'd be more concerned. Offsetting also that increase in equity risk premiums will perhaps be a slightly lower T-bond rate. So my guess is that the discount rate is not going to see a big shift as a result of it because much of the action is going to be in the numerator. So let me give you my preliminary shot at what the virus has done to the S&P 500. Here are my big assumptions. I'm going to assume first that there's going to be about a 5% drop in earnings in 2020 and that only half of that earnings drop is going to get recouped. So in the long term, earnings are going to stay lower because of this crisis. I'm also going to assume that companies are going to return less cash, 85% instead of 92% of their earnings as cash. So it's going to cause a cash flow drop. I'm not going to assume much in terms of equity risk premium, just a slight increase in equity risk premiums because as I said, I don't see this as the big factor driving value. With those changes put in, I come up with the value of about 3,003 for the S&P 500. Incidentally, I did this on February 25th after 2 really bad days. The Dow has dropped 1,800 points. The S&P 500 has had a pretty significant drop. And the first reaction people had was, is that a fear factor? Should I be buying now? And at least based on my estimates, I think the drop in value is justified given the potential for damage that this virus has. In fact, if I assume that the market was fairly valued at the start of the month, now it looks slightly overvalued even with the drop built in. So if you are looking at this drop saying maybe I should be doing bottom fishing, I'd hold off because there is good reason for what the market did over this week. It doesn't mean I'm going to go sell now. It's too late. I wish I'd sold a week ago, you could say about the index, but you could say that about almost every market crisis. Now, of course, there's an action phase. What do we do about this? For me, when I look at these numbers, there's not much it requires me to do right now. I don't feel the urge to buy. It's not like stocks have dropped too much relative to what they should have gone down by, at least based on my estimates. I don't feel the urge to sell either. They're not hopelessly overvalued. So for me, it's just stay doing what you're doing. You're saying, why don't you shift your stocks into sectors that are less affected? Well, it seems like a logical thing to do, right? Maybe I should be shifting my money out of travel stocks into stocks, food processing companies in the US. But remember, the damage has mostly been done. In fact, Shifting sectors now, I don't think is going to do much for me other than expose me to potential overreaction in those sectors. I know I don't want to give you advice because I shouldn't be giving you advice. This is something that each of us should work out on our own. In fact, my advice to you, stop listening to experts. Stop looking at what other people do. Start making your own judgments. If you get a chance, download the spreadsheet that I've included with this particular session and change the numbers. So if you don't like the 5% growth drop in earnings I have in 2020, you think it should be much larger, make your changes. And in fact, all you have are 4 numbers to change. Make the changes reflect your story. Come up with a number that reflects your views of the market and act on that number. We all have to take ownership of our investment actions. And today was my first step in taking ownership. Because let's face it, in a crisis like this, the first casualty is perspective. The second casualty is whatever investment philosophy you brought in. You abandon it. I do this partly to get perspective and to go back to my investment philosophy. Of course, I could be hopelessly wrong in hindsight, but that's always going to be true in investing. So thank you very much for listening. And whatever you do about the virus, just don't catch it. Bye.